Hi, everyone. Welcome back to this week's episode of The Wealth Cafe. I'm your host, Caroline Tannis, and I am lead financial advisor and founder of Tannis Financial Group, and I am so glad that you are here. Before we dive in today, I want to ask you a quick question, and I want you to actually sit with this for a second, not just breeze through this. Do you have life insurance? Maybe an annuity, or maybe even both. Policies that you set up at some point in your career, maybe when you had a young family or when a financial advisor told you that it was a smart move, and then you just kept paying the premiums and moved on. If the answer is yes, then today's episode is for you. Here's the thing I see all the time happening with women I work with. They are brilliant, they are accomplished, and they have built extraordinary financial lives. And a lot of them will have financial products sitting in their portfolio that were designed for a different version of themselves, typically a previous version of themselves. One that had a mortgage and dependent kids, and they had a big income they had to protect. But that was not the version of them that had a $5 million portfolio, a family legacy to build, and a estate that needed a completely different kind of strategy. So today, we are going to talk about a very different kind of IRS-approved strategy that allows you to exchange one of those old policies, life insurance or an annuity, for a newer and better one without paying a single dollar of taxes to do it. It's called a 1035 exchange, and if you have a policy that you haven't looked at in years, you're going to want to listen to every word of this episode. So grab a cup of coffee, get cozy, and let's dive in. So what is a 1035 exchange? And I want to start at the beginning because everybody comes from a different financial background and knowledge, so let's break this down. A 1035 exchange is named after Section 1035 of the IRS Code, and it's a provision that allows you to swap one life insurance policy or annuity for a newer, better one, and defer all of the taxes and any gains that you have accumulated. You're not telling the IRS, I'm not cashing out. You're upgrading, and the IRS says, okay, you can do that tax-free, but there are rules that you need to follow. And in order to do this exchange, here are a few of them that you need to follow. You can exchange a life insurance policy for another life insurance policy. You can exchange an annuity for another annuity. You can also exchange a life insurance policy for an annuity. Going in that direction is allowed. But what you can't do is exchange a life insurance policy for an annuity. The IRS is very specific about this, and it is really important detail to note. So why does all of this matter? And we're going to get into now the tax mechanics of why it's such a big deal. Let's say you bought an annuity 15 years ago. At that time, you put $200,000 into it, and today it is worth $350,000. That is a gain of $150,000 sitting inside of that policy. If you were to surrender it, meaning cash it out, you would owe ordinary income taxes on $150,000 of that gain. At a higher income bracket, you could easily owe $40,000 or $50,000 to the IRS. Boom, that money is gone. But if you are to do a 1035 exchange and you move the entire $350,000 gain into a newer, better annuity, that's a non-taxable event. You need to check with the IRS, with your tax accountant, and make sure that you have all of these different nuances set in order. This is the power, though, of a 1035 exchange when done properly. It lets you upgrade without the tax penalty that would normally come with cashing out or starting over. Now, let's talk about one of the biggest misconceptions that people have when it comes to doing a 1035 exchange. Now, people, and sometimes even a lot of financial advisors or insurance advisors, think of insurance and annuity products as a set it and forget it. You buy it, you pay the premiums, you leave it alone, but that thinking is costing you a lot of money because the products available today, the riders, the features, the structures, even the death benefit options are often dramatically different from what existed 10 or even 15 years ago. So you may be paying for coverage that no longer serves you. You could also be missing out on features that would actually make a difference inside of your bigger financial plan. And you might be able to fix all of that without triggering a single dollar of taxable income. Now, I want to specifically talk about this strategy and why it matters, especially for women at your level, because it looks a little different than it does for the general population. If you're in your late 40s, 50s, or 60s, there is a good chance that you are sitting on policies that were designed for a different version of your life, an earlier version. Now, you may have taken out a term policy back when you had young kids, and maybe you even had a mortgage that you needed to protect. You may have bought an annuity as a savings vehicle when you were still building out your career and you put them in place and they made sense at the time. Now, you may have just been sitting there and leaving these policies and you haven't looked at them since. But here's the thing, your life has changed dramatically and a lot of times for the better. But your policies in a lot of these circumstances haven't. So what changes at your level of wealth? When women at your level of wealth start to think about insurance, they are no longer thinking about income replacement, especially at this phase of life. They're thinking about it more so as an estate planning tool. Tax-efficient legacy vehicles, ways to pass wealth across different generations, maybe now even to those grandkids. And these are ways to fund for the people they care about, and you don't want to deplete your current investment portfolio. Now, the products that serve the goals look very different from that term policy you bought at maybe 38 years old when you had a couple of those young kids at home. A 1035 exchange gives you a tax-free path to get from where you are to where you actually want to be. Let's talk about the transition for those of you that are leaving executive roles. Now, this comes up a lot for those that are leaving the corporate world. Now, you may have had group life insurance through your employer that terminated on the day you left. You may even have something like deferred compensation that's been sitting in an annuity, or you may have that golden handcuff arrangement that is going to release the day you leave. The executive transition is often the exact moment when life insurance needs an audit and potentially a good time to do a 1035 exchange, and it can make an incremental difference in your financial future and for generations to come. Because you're already repositioning so many other pieces of your financial future, your insurance products need to be part of that conversation, and it's worthwhile just at least having a second review and at least having the peace of mind saying, okay, let's move forward with it. If you're taking a look at your estate planning, for those of you that are thinking about your wider estate, the next generations, that might be why you listen to so much of this show. And there are newer life insurance products like survivorship policies or index universal lives that might be dramatically more efficient estate tools than some of the older traditional term or whole life policies that you have that, if you have term life, may even be about to expire. Now, this is not a recommendation for any one policy, but just the signal that you need to take a look at what you have. This 1035 is going to allow you to start fresh and have a policy that is designed for your new phase of life. Now, I want to dive a little deeper into this topic because I need to give you the full picture rather than just, hey, you should consider a 1035 exchange, because we like to get a little deeper here on this podcast. Now, doing a 1035, you are not paying the gains. That's the 30-second version. That's what most people know about the strategy, and then they just stop there. But there is so much more to understand if you actually want to use a 1035 exchange and use it well in your financial picture. Now, if you are going to your financial advisor or your insurance person about this, let's talk about some of the mechanics behind it so that you can fully understand what's happening. Because there are rules here, and if your advisor doesn't get them right, you don't get the tax benefit. So let's go through the key ones. Rule number 1 is that the exchange must be direct. The funds must go from one carrier to the other carrier directly from your old insurance company to your new one. You cannot, and I repeat, cannot receive a check. You cannot have the money pass through your hands, even if it is for a day, a moment, whatever it is. The moment you touch that money, the IRS treats it as a distribution. You will owe taxes on the gain immediately, and this is probably one of the most common mistakes that I see in botched 1035 exchanges. Make sure your advisor or your insurance broker is handling the paperwork correctly and confirm it's a direct transfer. Now, rule number 2 is that the insured or annuitant must stay exactly the same. A 1035 exchange is not an opportunity to start changing who the policy covers. The same person who is insured or named on the annuity is who must be on the new policy. You need to remain the same here. If you're trying to change it, you've now broken the structure, and so you, in the rules and the eyes of the IRS, you have lost that tax protection. Now, rule number 3, make sure you are evaluating the surrender charges before you move. Some older policies, particularly annuities, they have surrender charge periods, and this is a fee that the insurance company charges you to withdraw or transfer money before a certain number of years. Now, sometimes these surrender charges can be significant and enough to eat away any of the benefit from you moving at all. You and your team need to run the math, and a good advisor will model out the surrender charges and communicate these to you well against the benefit of the new product to tell you whether the exchange actually makes financial sense for you, not just for them to try to sell you a product. So make sure you understand all of the ins and outs. Let's talk about another part of 1035 exchanges, and that is the partial 1035. And this is one most advisors will skip entirely because there's a little more work and analysis. You don't actually have to exchange the entire policy. You can do a partial 1035 exchange, which is moving just a portion of an existing policy over to a new one. Now, this is especially powerful when it comes to long-term care planning. Now, if you have an existing annuity that has grown over the years, you can actually use a partial 1035 exchange to move a portion of that annuity on a completely tax-free basis, that is key to note here, into a long-term care policy or a hybrid life insurance policy with long-term care riders. The key, though, is that it has to have this long-term care component. For women at your stage of life and building wealth for the long term, this is a really important thing to know because in so many situations, as women, we are taking care of everyone else, and we look at long-term care as a way to have somebody who can come in and take care of us, whether that is a nurse, being in a assisted living facility, or going into a nursing home and finding a strategy that works well. Now, I will use this strategy with clients because it is so underutilized as a wealth planning tool. It allows you to pick the lifestyle that you want to have now that you have more information and are later on in your career. Now, at your wealth level, a 1035 exchange isn't just a product swap. This is a strategic repositioning conversation, and it starts with a single question, and that is, what is the policy actually doing inside of my estate or inside of my greater financial plan? Is it providing liquidity for taxes if you're looking at the estate side? Is it going to fund something like a trust, life insurance down the road for future generations? Is it going to generate tax-free income in retirement? Is it protecting a business? There are so many parts to your financial plan, and you can strategically use a policy rather than sitting here saying, you know what, I'm just going to let this go, and whatever happens, the next generation can use it, or sitting here and saying, let me cash it out and just get this surrender charge and I'll deal with it. It was meant for me at the time, but for now I just want to cash it in and be done. Now, it is important to make sure you are communicating with your financial team, have the right people in place, and it never hurts to get a second look. It is something that should be part of your financial conversation every single year, and especially when you have major life events. If you are to have more kids, grandkids, if you're to lose a spouse, maybe get a divorce, maybe have a new spouse, or things are to change in the next generations. This way you can fully optimize what you have and make sure it is built for the life that you want. Now, if you are listening to this conversation and you're thinking, oh my goodness, I need to get the second look, I need that second set of eyes, you can head over to tanisfingroup.com/contact and apply for a complimentary intro call to get that second look and have a greater conversation on how does this all fit into my financial plan, and if no changes need to be made, at least you have that peace of mind. Thank you so much for joining me on this episode of The Wealth Cafe, and I look forward to seeing you again next time.